Surviving Inflation: Strategies for Protecting Your Money and Investments. Inflation is a fact of life. Over time, prices rise and the value of money declines, which can have a significant impact on your financial well-being. Inflation can erode the value of your savings, reduce the purchasing power of your income, and impact the value of your investments. Despite this, many people fail to take the necessary steps to protect their money and investments from the effects of inflation. This book aims to change that. Surviving Inflation: Strategies for Protecting Your Money and Investments provides readers with a comprehensive guide to understanding inflation and how it impacts the economy, your finances, and your investments. In this book, we'll explore the various strategies you can use to protect your money and investments from inflation. We'll look at investing in real assets, stocks, and bonds, as well as diversifying your retirement portfolio and increasing your savings. We'll also examine the risks of inflation and how to mitigate them, so that you can make informed decisions about your financial future. The goal of this book is to provide readers with a solid foundation for understanding inflation and its effects, as well as the tools and strategies necessary to protect their money and investments from the risks of inflation. We've brought together a range of experts to share their insights and experiences, so that you can learn from their successes and avoid their mistakes. By the end of this book, you should have a good understanding of how to protect your money and investments from inflation, and be well equipped to make informed decisions about your financial future. We hope that you find this book to be a valuable resource, and wish you all the best in your financial endeavors. Chapter 1: Introduction. Inflation is a fact of life that affects all of us in one way or another. Simply put, inflation is the increase in the price of goods and services over time. It's a natural part of economic growth and can be caused by a variety of factors, including changes in supply and demand, shifts in government policy, and global events that impact the economy. While inflation can be a sign of a healthy economy, it can also have negative effects on our personal finances. Inflation can decrease the purchasing power of our money, making it more difficult to save for the future, pay off debt, and maintain our standard of living. This book is designed to help you understand inflation and its impact on your money and investments. It will provide you with strategies for protecting your savings, investments, and retirement planning in an inflationary environment. In the following chapters, we'll discuss the mechanics of inflation, how it impacts the economy and your finances, and the risks associated with inflation. We'll explore different strategies for mitigating those risks, such as diversification and investing in real assets like real estate and commodities. We'll also provide guidance on how to protect your savings and invest in stocks in an inflationary environment, as well as how to plan for retirement in the face of rising inflation. By the end of this book, you'll have a better understanding of inflation and the tools you need to protect your money and investments from its effects. Whether you're a seasoned investor or just starting to think about your financial future, the strategies and insights in this book will help you navigate the challenges of an inflationary environment and build a secure financial future. Chapter 2: The Mechanics of Inflation. Inflation is a complex economic phenomenon that can be difficult to understand. In this chapter, we'll explain the mechanics of inflation and how it works. Inflation is the rate at which the general level of prices for goods and services is rising, and, as a result, the purchasing power of a currency is falling. Inflation is typically measured using an inflation index, such as the Consumer Price Index, which tracks the prices of a basket of goods and services commonly purchased by consumers. Inflation can be caused by a variety of factors, including changes in supply and demand, shifts in government policy, and global events that impact the economy. When there is more demand for goods and services than there is supply, prices tend to rise. This can occur, for example, when there is an increase in consumer spending or when businesses increase production costs. Similarly, shifts in government policy can also impact inflation. When governments increase spending or reduce taxes, they can increase the amount of money in circulation, which can lead to higher prices. In addition, global events like natural disasters or political instability can impact the supply of goods and services, which can also lead to higher prices. One of the key drivers of inflation is the money supply. When there is more money in circulation, prices tend to rise. This is because people have more money to spend, and businesses can charge higher prices for their goods and services. Conversely, when there is less money in circulation, prices tend to fall. Central banks play a crucial role in controlling inflation. They use monetary policy tools like interest rates to control the money supply and maintain price stability. When inflation is too high, central banks can increase interest rates to reduce the amount of money in circulation and decrease demand for goods and services. When inflation is too low, central banks can lower interest rates to stimulate the economy and encourage spending. Chapter 3: The impact of inflation on the economy. Inflation can have a significant impact on the economy, affecting everything from economic growth to unemployment rates. In this chapter, we'll explore the ways in which inflation impacts the economy. One of the main impacts of inflation on the economy is that it reduces the purchasing power of money. When the cost of goods and services increases, people need more money to buy the same things. This can lead to decreased consumer spending, as people are less likely to make purchases when prices are higher. As a result, businesses may experience lower sales and may need to raise prices even further to maintain profitability. Inflation can also impact interest rates, which can have ripple effects throughout the economy. When inflation is high, central banks may raise interest rates to reduce the money supply and control inflation. Higher interest rates can make it more expensive for businesses to borrow money, which can lead to lower investment and slower economic growth. Conversely, when inflation is low, central banks may lower interest rates to stimulate the economy and encourage borrowing and investment. Inflation can also impact the labor market. When inflation is high, employees may demand higher wages to keep up with the rising cost of living. If businesses are unable to afford higher wages, they may need to lay off workers or reduce hours. This can lead to higher unemployment rates, as businesses try to maintain profitability in the face of rising costs. Inflation can also impact international trade. When the value of a currency decreases due to inflation, it becomes less expensive for foreign buyers to purchase goods and services from that country. This can increase exports, as foreign buyers can get more for their money. However, it can also lead to higher import prices, as it becomes more expensive for domestic buyers to purchase goods and services from other countries. Chapter 4: The impact of inflation on your finances. Inflation can have a significant impact on your personal finances, affecting everything from your savings and investments to your retirement planning. In this chapter, we'll explore the ways in which inflation impacts your finances. Inflation can reduce the purchasing power of your savings over time. If you have $1,000 in savings and the inflation rate is 3%, the real value of your savings will be reduced to $970 in 1 year, and even less in subsequent years. To combat the impact of inflation on your savings, it is important to consider investing in assets that are likely to appreciate in value at a rate higher than inflation, such as stocks or real estate. Inflation can also impact the value of your investments. For example, if you invest in a bond with a fixed interest rate of 3% and the inflation rate is also 3%, your real rate of return is 0%, meaning your investment is not keeping up with inflation. Similarly, if you invest in stocks, you will need to consider how inflation impacts the company's earnings and future growth prospects. Inflation can also impact the performance of different asset classes, with some performing better in inflationary environments than others. Inflation can have a significant impact on retirement planning. If you are saving for retirement, it is important to consider how inflation will impact your retirement expenses. For example, if you plan to retire in 20 years and your current expenses are $50,000 per year, you will need to save significantly more to account for the impact of inflation. Even if you have already retired, inflation can impact your retirement income, as the purchasing power of your pension or Social Security benefits may decrease over time. Inflation can impact both sides of debt, reducing the real value of debt owed and increasing the real value of the interest payments. While this may seem like a benefit to borrowers, high inflation can also lead to higher interest rates, making it more expensive to borrow in the first place. Chapter 5: The Risks of Inflation and How to Mitigate Them. Inflation can pose a number of risks to your finances, including reduced purchasing power, decreased investment returns, and increased interest rates. In this chapter, we'll explore the risks of inflation and strategies for mitigating them. One of the primary risks of inflation is reduced purchasing power. As the cost of goods and services increases, the value of your money decreases. To mitigate this risk, it is important to invest in assets that are likely to appreciate in value at a rate higher than inflation, such as stocks or real estate. You may also consider purchasing inflation-protected securities, which are designed to provide returns that are adjusted for inflation. Inflation can also impact the returns on your investments. For example, if you invest in a bond with a fixed interest rate and the inflation rate increases, the real value of your investment will decrease. To mitigate this risk, you may consider investing in assets that are likely to appreciate in value at a rate higher than inflation, such as stocks or real estate. You may also consider purchasing Treasury inflation-protected securities, which provide a fixed rate of return that is adjusted for inflation. Inflation can also lead to increased interest rates, which can impact the cost of borrowing and the performance of fixed-income investments. To mitigate this risk, you may consider investing in assets that are likely to perform well in an inflationary environment, such as commodities or real estate. You may also consider diversifying your fixed-income investments to include assets with varying maturities, which can help to mitigate the impact of rising interest rates. Inflation can have a significant impact on retirement planning, as it can reduce the purchasing power of retirement savings and increase the cost of living. To mitigate this risk, it is important to develop a retirement plan that takes inflation into account. This may include saving more aggressively, investing in assets that are likely to appreciate in value at a rate higher than inflation, and adjusting your retirement spending to account for the impact of inflation. Chapter 6: Strategies for Protecting Your Savings. Inflation can significantly reduce the value of your savings over time, making it important to take steps to protect your money. In this chapter, we'll explore some strategies for protecting your savings from the effects of inflation. One of the most effective strategies for protecting your savings from the effects of inflation is to invest in inflation-protected securities, such as Treasury inflation-protected securities. These securities are designed to provide a fixed rate of return that is adjusted for inflation, meaning that your investment will keep pace with inflation and maintain its purchasing power over time. Another strategy for protecting your savings is to diversify your investment portfolio. By investing in a mix of asset classes, such as stocks, bonds, and real estate, you can help to reduce the impact of inflation on your overall portfolio. While no investment is entirely immune to inflation, some asset classes are better positioned to perform well in an inflationary environment than others. Invest in real assets, such as real estate, commodities, and precious metals, can be an effective way to protect your savings from inflation. Real assets have intrinsic value that is not dependent on the value of a currency, meaning that their value can appreciate in an inflationary environment. However, it is important to carefully consider the risks associated with investing in real assets, such as the potential for volatility and liquidity concerns. Another strategy for protecting your savings is to save more aggressively. By saving more money, you can build a larger nest egg that is better able to withstand the effects of inflation. This may mean cutting back on discretionary spending, finding ways to increase your income, or making other sacrifices in the short term to secure your financial future in the long term. Finally, consider a high-yield savings account as an option for protecting your savings. High-yield savings accounts typically offer higher interest rates than traditional savings accounts, which can help to offset the effects of inflation. However, it is important to carefully evaluate the terms and conditions of any high-yield savings account before opening one to ensure that it is a good fit for your financial goals. Chapter 7: Investing in Real Assets. Investing in real assets, such as real estate, commodities, and precious metals, can be an effective way to protect your investments from the effects of inflation. In this chapter, we'll explore some strategies for investing in real assets to help you protect your wealth in an inflationary environment. Investing in real estate can be a powerful way to protect your investments from the effects of inflation. Real estate tends to appreciate in value over time, meaning that it can provide a hedge against inflation. Additionally, owning real estate can provide a source of passive income through rental income or capital gains when the property is sold. However, it's important to keep in mind that investing in real estate also comes with its own risks and challenges. For example, real estate investments require a significant amount of upfront capital, and there are additional expenses associated with property maintenance, taxes, and insurance. Additionally, real estate investments can be illiquid, meaning that they can be difficult to sell quickly if you need to access your funds. Investing in commodities, such as gold, silver, and oil, can be another effective way to protect your investments from inflation. Commodities tend to hold their value well in an inflationary environment because they are tangible assets with intrinsic value. Additionally, commodity prices can rise as a result of inflation, providing investors with an opportunity for capital appreciation. However, investing in commodities also comes with risks. Commodities can be volatile and subject to sudden price swings, and they may not provide a consistent source of income. Additionally, investing in commodities may require specialized knowledge and expertise, which can make it challenging for individual investors. Investing in precious metals, such as gold and silver, is a popular strategy for protecting investments from inflation. Precious metals tend to hold their value well in an inflationary environment, and they have a long history of serving as a store of value. Additionally, precious metals can provide a hedge against geopolitical risk and other economic uncertainties. However, it's important to keep in mind that investing in precious metals also comes with its own challenges. Precious metals can be volatile, and they may not provide a consistent source of income. Additionally, investing in physical precious metals, such as gold bars or coins, can be expensive and may require specialized storage and insurance. For investors who want to invest in real assets but don't have the time or resources to invest directly, real assets exchange-traded funds can be a good option. Real assets ETFs allow investors to gain exposure to a diversified portfolio of real assets, such as real estate, commodities, and precious metals, through a single investment vehicle. Real assets ETFs can provide investors with the benefits of real asset investing, such as inflation protection and diversification, while also offering greater liquidity and lower costs than direct investing in real assets. However, it's important to carefully evaluate the fees and underlying assets of any real assets ETF before investing. Chapter 8: Investing in Stocks. Investing in stocks can be a powerful way to protect your investments from inflation, as well as to grow your wealth over the long term. In this chapter, we'll explore some strategies for investing in stocks to help you protect your wealth in an inflationary environment. One way to protect your investments from inflation is to invest in companies that have pricing power, meaning that they have the ability to raise prices to keep up with inflation. Companies that sell essential goods and services, such as healthcare or utilities, may be less vulnerable to the effects of inflation than companies that sell discretionary items, such as luxury goods or travel. Additionally, companies that have a history of consistent dividend payments can be a good option for investors looking to protect their investments from inflation. Dividends can provide a source of income that can help offset the effects of inflation. However, it's important to keep in mind that investing in individual stocks can be risky, as individual companies may face a variety of challenges and risks. Additionally, individual stock investing requires specialized knowledge and expertise, which can make it challenging for individual investors. For investors who want to invest in stocks but don't have the time or resources to invest directly, stock mutual funds can be a good option. Stock mutual funds allow investors to gain exposure to a diversified portfolio of stocks through a single investment vehicle. Stock mutual funds can provide investors with the benefits of stock investing, such as growth potential and diversification, while also offering greater liquidity and lower costs than direct investing in individual stocks. However, it's important to carefully evaluate the fees and underlying stocks of any stock mutual fund before investing. Exchange-traded funds are another option for investors looking to gain exposure to a diversified portfolio of stocks. ETFs are similar to mutual funds, but they trade on an exchange like individual stocks. ETFs can provide investors with the benefits of stock investing, such as growth potential and diversification, while also offering greater liquidity and lower costs than direct investing in individual stocks or mutual funds. However, it's important to carefully evaluate the fees and underlying stocks of any stock ETF before investing. Chapter 9: Strategies for Retirement Planning in an Inflationary Environment. Retirement planning is an important consideration for anyone, but it can be particularly challenging in an inflationary environment. In this chapter, we'll explore some strategies for retirement planning that can help you protect your savings and investments from the effects of inflation. One of the simplest strategies for retirement planning in an inflationary environment is to increase your savings. As the cost of living increases, you'll need more money to maintain your standard of living in retirement. By increasing your savings, you can help ensure that you have enough money to cover your expenses in retirement. Inflation-protected securities, such as Treasury inflation-protected securities, are another option for retirement planning in an inflationary environment. These securities provide a guaranteed rate of return that is adjusted for inflation. This means that the value of your investment will increase in line with inflation, helping to protect your savings from the effects of inflation. If you're able to do so, delaying retirement can be an effective strategy for retirement planning in an inflationary environment. By working for a few extra years, you can continue to save and invest, which can help offset the effects of inflation. Additionally, delaying retirement can help ensure that you have a larger Social Security benefit, which can also help protect your retirement income from the effects of inflation. Investing in income-producing assets, such as bonds, can be another strategy for retirement planning in an inflationary environment. While bonds may not provide the same level of growth potential as stocks, they can provide a reliable source of income that can help offset the effects of inflation. Diversification is an important consideration for any retirement portfolio, but it's particularly important in an inflationary environment. By diversifying your portfolio across a variety of asset classes, you can help ensure that your retirement savings are protected from the effects of inflation. Additionally, diversification can help spread risk across your portfolio, which can help protect your investments in the event of a downturn in any one asset class. Chapter 10. Conclusion: Inflation can have a significant impact on your finances, from the value of your savings to the cost of your daily expenses. However, with careful planning and the right strategies, you can protect your money and investments from the effects of inflation. Throughout this book, we've explored the mechanics of inflation, the impact of inflation on the economy and your finances, and strategies for protecting your money and investments from the risks of inflation. We've looked at a variety of options, from investing in real assets and stocks to diversifying your retirement portfolio and increasing your savings. While there's no single solution that will work for everyone, the key takeaway is that the best way to protect your money and investments from the effects of inflation is to have a well-rounded strategy that takes into account your individual goals and risk tolerance. By staying informed about economic trends and taking proactive steps to protect your finances, you can weather the effects of inflation and continue to grow your wealth over time. With the right strategies and a long-term outlook, you can ensure that you're well-positioned to achieve your financial goals, both now and in the future. Thank you for taking the time to read this book. We hope that the information and strategies presented here will help you make informed decisions and take the necessary steps to protect your money and investments from the risks of inflation. This book that was authored by OpenAI's ChatGPT. With a company taking on billions of dollars in investments, this is the perfect time to find out ways for this innovative tool to help you learn how to survive inflation. Audio for this book was provided by NaturalSoft Limited's Natural Reader AI software using their commercial license. Per their website, this license allows you to use its software and voices for commercial or public use. This includes, but is not limited to, YouTube videos, public announcements, broadcasts, and e-learning.